Okay, you can.
I don't have the chat link, by the way. Good afternoon, good morning, and good evening, everyone. This is Joseph Trevisani from Worldwide Markets with our weekly installment of what is happening in the world, which is a grand way of putting it. The chart you're looking at, I'm going to do something a little more freeform, granted, than I normally do here today, because what I'm trying to do is we all spend a good deal of time listening and reading about economic statistics. It's part of what we do. It's part of our job, and we probably find it interesting or we wouldn't be here. Certainly that's true for me. The problem we have for all of us, is certainly that I have as an analyst and as a commentator, is one, focusing on what do I focus on? What's actually important? And two, and even more important, is since I get my information, as we all do, largely through the media, I am attempting here to go around, bypass the narrative that you normally have from any set of commentators or statistics and come up with some alternative view of looking at things. Aside from what the Fed is doing, the difficult assessment, and I'm just going to focus on the United States here, is, of course, what is the condition of the U.S. economy? Oh, hold on a second, let me just get something here. Okay, here's the link. Okay, got it. Thank you, Adenda. Again, I thank you all for coming. I consider it a compliment that people will take time out of their day to listen to what I say, and perhaps even pay attention. I know no one is here because I'm a very funny comic, or because it's a runway and I'm particularly good looking. Anyway, you can't get to look at me anyway, so it doesn't really matter. However, I do thank you for attending and listening to what I have to say. Now, as I always run these things, if anyone has any comments or considerations or jokes or anything else, I'm always asking for jokes, and I will admit that I never get any, and I never provide any myself. Please type it into the chat and I will answer as best I can, or perhaps anyone else who is listening will answer as well. There is as much knowledge in the audience as there is on the podium, perhaps more. The difficulty is in establishing a narrative. Well, let me put it a different way. What journalists do, what I do, is you look for a narrative. It's very difficult to write something or say something without a series of points that follow and produce a picture. That's what you try to do. That's what I try to do when I appear here. That's what I try to do in my writings, and also when I do any media appearances. Much of the narrative that you will encounter is standard. Journalists are no better and no smarter than anybody else. A few economists are, most are not, although they're well versed in their field. The narrative tends to be the general narrative. This may or may not be, as they say downtown, talking their book. In many cases it is. Certainly in many of the commentary, much of the commentary you'll hear on television is often just people talking their book. Now, that isn't meant to be in some sort of derogatory sense, but the old phrase, how you vote is conditioned by where you sit. It has to do with your economic interests. Stocks tend to be a upwardly biased investment. So stock narratives tend to be, look at the bright side of things. FX analysts are, or should be at least, agnostic. It doesn't matter to any of us which way the market goes, whether it goes up or down. What it matters is that we get the direction right and we get the timing right. And if there's a trend, we sit on it properly. We also have to remember to cut our losses, but that's another story. So we should not really care which way the economy is going. Problem for us, of course, is that along with everyone else, we don't have a narrative bias. Although a lot of what you listen to tends to be stock biased, stock based, which is a bias upward. For us, no, we don't have that as analysts primarily concerned with currency directions. But we don't get absolved from having to try and figure out what the economy is doing, because even though it's diminished lately, and that's why I have this chart up here, the prime mover for foreign exchange remains relationships between central bank rates from the various rates around the world. And that is what we're looking at here. So just a brief comment on this chart. The charts today, and don't anybody say, I'm not surprised, are going to be slightly more confusing. I will do my best to explain them. Some of them are a little confusing to me as well. I'm looking for a relationship that is not a direct relationship, that may reflect other things. As we all know, coincidence in time and in direction is not causality. And here's an example we have in front of us. Okay, this chart is a chart of US GDP, which is the white squiggly line, and the thicker gray line, which is the 5-year, if I remember, the 5-year trend, the 5-year moving average. Okay, that's for GDP. The green line is population. Remember, this is change in GDP. It's not absolute. If you put up an absolute, it tends to look just like the population line. You don't learn anything from it. Orange is the Fed funds rate. Now, here's what I mean by causality. I mean coincidence and not necessarily causality. What do we see comparing? Ignore the population. Let me just put up the chat line here. Okay, ignore the population. I just put that up because it was already up. Anyway, what do we see from this chart? If we didn't know anything else, it would appear in the general sense that the lower the Fed funds rate, the lower the GDP. Again, does this prove any sort of relationship? Well, you probably could, but it's going to be very much against what you are expected to know. Now, again, to explain this, let's think about this. And this is just sort of an introduction to what I'm trying to do here today. Adinda, I know you're listening. I'm sorry, just one second. I just want to make sure that the chat questions come over if there are any. I'm looking at the chat page. I just want to make sure if there's any comments or questions, they come over the chat, so I'll see them. So here we have a Fed funds rate that seems to follow the GDP down. Now, if we are assuming causality, it depends which way it runs. If we assume that the Fed funds rate is determinant, wherever it is, of what GDP is likely to do, then we're going to assume that the lower the rate, the lower the GDP, and we've got the wrong relationship. If we look the other way and we say that the inflation, that the Fed funds rate follows GDP, so then as GDP comes down, it makes, you could say it makes sense because the Fed wants GDP to be higher, so the lower GDP goes, the lower the Fed funds rate goes. I would say that neither one of these is particularly determinant in this case. The external factors that are affecting GDP are probably the result. Now remember, through all this period here, up to say 2000, or the 9/11 attacks, the Fed was lowering GDP, was lowering the Fed funds rate because it was successfully squelched out inflation in the US economy. Okay, so we have to be careful of causality in what we're discussing. So let's move on to the housing market. Okay, that's just GDP with moving average. We don't want that one. I just did that one. Okay. Now this is, let's do one with a longer range. Oh, let's do this one right now. Okay. Okay, this is, now, I was surprised when I started putting these charts together that Bloomberg, which I depend on, all these charts are Bloomberg, by the way, a great system, nothing like it. However, their existing home sales only goes back to 1999, and I could not find longer range. I'm sure it exists, but I searched for 2 hours and I couldn't find it on Bloomberg. So I'm using housing starts and new home sales sort of as a proxy. New home sales especially is a good estimate. It works on a different level. In other words, it's about 1/10 of what the overall home market is, but it rises and falls in almost exactly the same pattern. So for what I'm trying to prove, it doesn't really matter here. Okay, so what do we have here? The yellow line is US population, rising steadily. The interesting fact of the US population increase in the past 50, almost 60 years, what is it? That it's going up? No. That the slope of that line barely changes. That means that the delta change on, it sounds it's like I'm very mathematically versed, doesn't it? I'm not, I'm an English major from a long time ago. So the slope of that line is the population change, the yellow line, which is the population line. That means that the population change in the United States, and I looked at the actual figures, is relatively constant. How could that be? If you think about it, because as the population grows, there are more people, more couples, more women to have children. So if the rate of births stays the same, then the population increase per year should rise with population. And of course, we have the answer to it. One, the rate of births is not rising, it's actually falling. Although I think it's stabilized in the United States, and it has been stable. And it's actually gone up slightly. And it's the actual birth rate in the United States is about replacement level. Then how does population rise? Obviously, the answer is pretty easy. It's immigration. But the immigration is a function, of course, of government policy. Now, as you can tell, this figure doesn't, even though under Obama, the current president, there has not been a great change in the immigration rate, despite what you might hear from various media and election types here in the United States. We're having an election here, of course. Immigration rates are a function of government policy. And the remarkable fact since the 1950s, since the Second World War actually, is the very constant rate of population change, largely determined by immigration rates. So another fact here, and this is something I came to when remember this is housing starts. When I first started looking into this to prepare for this webinar, my initial assumption was that as the population rises, there'll be more new home starts every year. Is that what that chart shows us? It most assuredly is not. Take this one right here. This is housing starts with this is a 10-year moving. Housing starts with was that new home sales or, hold on. Okay, no, that's the right chart. This is the same chart we saw before with a 10-year moving average. So you get a better sense of the movement as population changes. And what do we see? That apparently is not population size which determines new home starts. I was not quite floored by this, but I was surprised when I saw this. And what is that? And I thought about it for a while, and then I realized that excuse me for 1 second, I have a bit of a cold. Sorry about that. The determinant for new home starts seems to be, I'm sure there's studies out there, but I haven't read them. Oops, this chart's not up. Whoops, sorry. Okay, my apologies. My apologies for that. Okay, here we go. So, yellow line population, white line new home starts, monthly, purple line, decade moving average for new home starts. Despite all the screaming and yelling about the U.S. housing crisis and housing bubble, the highest point of new home starts in January 2006 was not even the highest on record for the United States. Check this out. That graphic, very erudite way of putting it. There were 2 million, some 0.3 basically in 2006. Everyone's screaming about the housing bubble, okay? Back in 72, there were 2.5 million. Okay, the population here was, a little less than about 300 million, maybe a little less. The population back in 1970, well, it was maybe 250 million or something like that, 220, 230 million. 70 million difference in population, give or take. Yet there were more housing starts back in 1972. That's a rather astonishing figure, and I had to think about it for a while as to why that would be. There are two reasons, at least with my analysis here. One is that housing starts are determined not by the population size, but by the relation to the population increase. And two, they are most assuredly, this very obviously, a cyclical business based on somewhat interest rates, but mostly just the business cycle. This is a very repetitive pattern. What is the difference between this pattern and these patterns back here? The difference is duration. From this period here, if we look at, let's go back to this one. Yeah, this one. Okay, this is Fed funds. Remember the period here. Let me do this more closely so we all see it right here. This, if you look at here, I got another one here. Let me show you a better one. Okay, this is new home. Oh, this is newest homes. I want to use housing home sales. I will use new home sales. It works as well. Okay, because remember the charts, all three housing categories in the U.S. show more or less the same pattern. Although the variation is different as far as the amounts, the pattern is very similar. And the three are new home sales, housing starts, that I'm using, housing starts. And we also have existing home sales, but I don't have it that far. Okay, so this is new home sales. I generally judge the, in my charts lately, I've been using the 2000 approximately as the beginning of the housing bubble, okay? And here it's interesting that the housing new home sales breaks through the prior peak in November 2001 and then never drops back. Here it went above and dropped back, but here it never went back. So if you take about 2001, the end of 2001, let's take a look at this chart. And what happens in 2001? We get this long period when Alan Greenspan cut the rates after 9/11. This increase back here, this right here, is Bernanke trying to, well, he never quite said it, but the housing bubble was a problem and he wanted to deflate it. Okay, since then, it's all been low. So it seems that the determination for, okay, housing starts 1960. Okay, here we go. For housing starts, is interest rates more than it is population, more than it is even the change in the delta in population every year. Housing starts, remember, what I'm looking for here is the relation to the US economy. I'm not trying to do an analysis of the housing market, although, of course, that's inevitable. What I'm looking for is what is the housing statistic that will give us a greater insight. It's like looking to the state of the US economy, because there's a lot of bombast and secret knowledge and all sorts of other things that people are using out there saying the US economy is great. The US housing market is back. I don't believe that, and I'm going to show you why that is true. It is, I'm trying to do something equivalent when people analyze China, where analysts routinely distrust the data out of China. So what they do is they look for secondary statistics. Electricity use is one. Shipping is another, things like that. And that's what I'm trying to do here. I'm taking that sort of paradigm and using it here. Okay, so we look at this and we say we get interest rates. Okay, now let's look at, okay, this is home ownership, the labor force participation rate, and housing starts. Sorry, my apologies. In green. No, I'm sorry. Sorry. The unemployment rate. Okay. So this is what we have. We have home ownership, labor force participation rate, and unemployment. Using unemployment here as a proxy for the economy. And this is a distressing statistic if you look at it. So we have home ownership. Peak about 2000. Now, part of this, of course, is the ridiculous run-up in the housing bubble, but been falling ever since, slight bumps since then. Then we have labor force participation rate, which is not up back here before, say, 2000, or before right about here, maybe 98. There's not much of a relationship. I mean, that's not entirely true. Here, you get labor force participation rising, and you get home ownership rising. Okay, that makes sense. Here, it plateaus a bit, and you get pretty much a plateau it goes down a little bit from 66 to 63. In the 80s, there was a very vicious recession, worst one until the recent one in the early 80s, which drove it down and went back up again. The distressing fact of this chart is that if you were thinking economically, home ownership rates should fall as unemployment rises, depending, of course, on the duration. But as it falls, unemployment, you'd be using unemployment as a proxy for the economy, the health of the economy, you would expect that home ownership would rise again. And that is most assuredly not the case that we are seeing in this chart. What happens, and what I'm looking at the charts, and we're trying to see if there's if it's just coincidence or causality here. If unemployment rate is giving an accurate depiction of the state of the economy, it goes down, the economy is doing better. Just check the chat here. I see. Oh, sorry. Okay, let me turn up the volume on the mic. I see that. Is that better? Okay, sorry, but I hope you can hear me better now. I turned up the mic a little bit. Okay. Okay, cool. Okay, so back to this chart here. I just want to make sure that it was there. I saw the comments, so thank you. I did forget to put a chart up once, and I corrected myself. Okay, so if the economy is being depicted by the unemployment rate, which is green on this thing, on this chart, then to my analysis, something has either broken down in the relationship, or the yellow line, which is labor force participation rate, is giving a better picture of the economy. It seems logical to me. For this period here, you could say the bubble years, I could understand why the home ownership rate might go up. Since during those years, many people, we don't know how many, I don't know how many anyway, bought homes that they either couldn't afford and later lost them because of the various aspects of mortgage and interest rates during that period. But the fall since then, until this very bottom here, which is now below the lowest point from the 1980s and the recession there, and all the way going back to the 1960s, which means, and we are talking about cultural facts here, that in the 1960s, the majority of women in the United States did not work. Now, as they joined the workforce, and certainly many women work, most women work, I don't know if most women work, but many women. My assumption is most women work here in the United States. I don't actually have that statistic. And if anyone out there knows it, let me know what the participation rate of the females in the United States is in the workforce. I don't know. I'm assuming it's 75 or 80%, but that's my assumption. I could look it up, and I forgot to look it up today. So it seems to me from this chart here that if you're looking at home ownership as an indicator of the health of the economy, more people, at least in the United States, it has always been a cultural goal for a long time, at least 50 years and probably more, since the Second World War, and I think before that, certainly since the explosion of the suburbs after the Second World War. We're all a product of the baby boom. I am myself. That home ownership has been, and it's a goal that's been encouraged by the government. How do you say? Well, in the United States, interest on home loans is tax deductible. I don't know that there are many other countries where that is true. And if anyone knows, please let me know and put it into the chat and we'll know. So with government encouragement, it would seem that something has changed after the housing crash. Now here, we got a change there because this was the beginning. The housing bubble started to deflate before the economy went into recession for obvious reasons. So much of the housing had been based on securitized products that were based on ever-rising home prices. That didn't happen, so the housing market started to move first because I basically ran out of buyers. And I'm going to show you a chart that tells you the difference in that. So the labor force participation, without looking for the causal factor, just looking at the chart, the labor force participation rate, logically, seems to be much more predictive of the home ownership rate than does the employment rate. So the other assumption we can make based on that is that if the cultural attribute hasn't changed, that is, many people in the United States, we're assuming the same percentage, would still prefer to own their own homes. 2 people in my office just bought homes, actually. I have a relatively small office, and 2 of them did. If we assume that cultural desire is relatively unchanged, then the determination is really the health of the economy, whether you can afford a home or not. And if the unemployment rate is telling us that the economy is getting better and very rapidly, and the labor participation rate is telling us it's really not. And we assume that home ownership is a goal tied to the health of the economy, whether you can afford it or not. Then the assumption I have to make, based on this chart, is that the economy is better depicted by the labor force participation rate than by the unemployment rate. Okay, I'm just going to leave that right there. Well, we're going to move on to some other charts here. Okay, now, remember, I'm using housing starts as, let's use housing starts. Let's do it this way. Chart's coming. I haven't forgotten. Okay, housing starts. Now, remember the population. Let's get a population chart here with population, okay? This is housing starts and population. Let me make sure it's up there. Come on, Google. Come on, Google. Okay, there we go. Housing starts and population. It's the same chart I had up before, but without the calculations on it. The graph for housing, for population, we have a relatively unchanging delta in that every year. It's like between 2 and 2.5 million almost every year. The United States population grows by. A lot of that is immigration, actually. It's the largest part of that is immigration. It is not a rise in birth rate in the United States. Okay, so housing starts are clearly related. Because of the variation, they're more related since there's not an upward tilt to the housing start numbers. It's determined, it seems to me, by, as far as the population factor goes, by the delta of the population rather than by the absolute size. Okay, so just keep that in mind. Okay, now we're going to go back to this chart. Okay, so remember what I said earlier about labor force participation of the prior chart and the difference and the comparison to the home ownership rate, and that the labor force participation rate seemed to have more of a correlative. Oh, this might not be up. I have to ask, is the chart up? It seems to me that it is, but this thing can be a little. All right, can everyone see the chart? Okay. You can, okay, fine. Sorry. Okay, everyone can see the chart. Cool, it's U.S. housing starts. I'll make sure it's the right chart. It used to show in this little box down here, and now it's not. Let's see what I'm doing down here. Oops, I don't know what that is. Oops, wrong thing. Okay, well, everyone can still see the chart, right? Okay, good, thank you. I appreciate the feedback. I'm not sure what I'd be doing without it, frankly. Okay. U.S. housing starts here. So remember the prior chart. It seemed that the labor force participation rate, which is a negative because it's going down, and the excuse you hear from a lot of people is, excuse, but the explanation. Oh, it's not going down because the economy is not good. It's going down because people are retiring. That is not true. There is some component of it that is true, but it does not provide an explanation for the very large and rapid decline in labor force participation. So when you hear that, discount it, because there is a delta there which is not explained by the drop in population. Okay, by the change in the composition of the population as baby boom people get older and retire, although most of them I know are not retiring anyway. So okay, so here. This is another way of looking at the health of the economy as portrayed in housing statistics. Remember, I'm looking for, I don't know if this is correct, but I'm going to say it anyway, second level inferences. I'm not looking for the direct measure of U.S. economy. I'm looking for the portrayal of that in other statistics. Okay, so this is housing starts. I actually sent out a column on this last week. The housing start statistics from the Census Bureau. These are generally new homes started, and the bulk of them are I won't say attract homes, but they're not the luxury items. That's a small market. It gets a lot of play, but it's a small market. The majority of the homes that are started here in the United States are relatively inexpensive as you know, along the lines of the entire housing market. So if housing starts are relatively stable, which is what we're going to find out here, we know what the reason is, at least what my supposition is, that they're related to the delta change in population, which is relatively stable. Actually, it's delta, you don't have delta change. A mathematician, I'm not. So this is US housing starts, which I'm using as a proxy for the economy. And what do we see? From 1959 to 1999, that's 40 years. 40 years in which the US population grew by almost 100 million. Not quite, but almost. The average was 1.05 million per year. Now, throughout that period as well, the increase in population was between 2 and 2.5 million. Now, I am not attempting to say that every one of these people coming to the United States goes out and buys a house. That's absurd. But with the variation of the housing starts cyclically based largely on the business cycle and, of course, interest rates, which are sort of saying the same thing in a traditional central bank countercyclical money policy, monetary policy. The relative stability of housing starts is, I think, the most interesting fact relating to the economy. Yes, you get a relatively large variation, but it is not a rising statistic. It's a cyclical statistic. There's a difference. The size of the economy is a rising statistic. It follows population, the absolute size, not the change. The absolute size, and not the rate, but the absolute size of the economy is a rising statistic. Existing home sales tends to be more of a rising statistic. I can't prove it because, as I said, I couldn't get a statistic going back far enough. Housing starts is not. Housing starts is cyclically related to the housing market and to interest rates and things like that. So from 1959 to 2006, from 1959 to 1999, there were an average of 1.5 million housing starts in the United States each year. SAR. You know, what's that? Seasonally averaged adjusted rate. Okay? If you include to 2016 with the drop of the housing bubble, you get an average of 1.442. Since the housing crash, that statistic has been very different, of course. You can take a look at it right there. What I did is I took the average for 2015 and 2016, which is a year and a quarter. This statistic runs through March of this year. You have a 1.113 average. That is about a third less than the period. Now, you can look at this chart and say, well, all that's happening here is that the new home starts are down throughout this period after 2010 because you had overbuilding, and so it just is making up the difference to get back to the average of 1.442 or 1.509. Turns out that is not the case because I ran the numbers, as they say. Now, I took as a start in the housing bubble, somewhat arbitrary, 2000. So I looked at the excess above average. Remember, I used the average of 1509 from the 40-year period here. I looked at the excess over the average from 2000 until the peak which I took as December 2006, which is right here. So this period here, right? The excess over average right here. This is the average. Okay. Yes, I will put my email address at the end. Actually, I'll ask Adinda to do it at the end, and you can send me a question anytime you want. I will always answer, but I'll put it in at the end. Adinda, would you, if you have a chance, could you just type in my email address, jtrevisani@worldwidemarkets.com. Thanks. Okay, so I took the average over the amount over the average on these years, over average, and that was, so it was through this period here, the average was 287,000 a year, above the 40-year average for this period. Okay. That gives you an additional number of starts for this period here of 2.009 million units. So that is the excess created by the housing bubble. Okay? Then, for this period here, right to here, actually, okay? For the following 9.25 years from here unto the end, from January 2007 through this March. So I'm counting this entire period from here to here. The housing starts averaged 875,000 a year. Okay, from this period here, let me give you the numbers again so that we know, because I know I'm looking at the numbers, but you have to listen, so it's a little harder. From here to here, the housing bubble starts with 287,000 units above each year, for a total, new home starts averaged 1.796 for this period, for a total of 2.009 million units above the average that would have produced for this period this period back here from 1959 to 1999. From the peak here through the end here, starts averaged 875,000 units, or 634,000 per year below the average of 1.509. That produces a total number of starts for the period below the average of 5.865. So you have a surplus here of a little more than 2, and you have a deficit here relating to the average of a little bit of almost 6. So that gives you a total deficit for this period here relating to the average of 1.509 per year of almost 4 million units. So the lingering of the housing start market, the construction market, is not because there was such a huge surplus produced that until it was sold or moved, builders are not going to build anymore, because there is a large deficit, almost 4 million units across this period. So this chart, as with the labor force participation chart, now I'm not going to go through what I think are the logical linkages here. That's a much larger and a much more academic type or research type paper. But I am trying to use the housing statistics as a proxy rather than a direct read, which you get from everywhere else, on the economy. So there is a reason why this deficit exists. As the labor force participation rate decline exists for a reason. It is not sufficient to say for the labor force participation rate that let me show you another good chart of this. That's the one I used, okay. Let me see the other chart, here it is. Okay, this is another example, another use of the same thing, okay? So this is another graphic representation, if you will. Everyone can see this chart. It has a red and a gray box on it, so that should be helpful. The period I was just talking about, January 2000, December 2006, starts average 1.796 million per year. From January 2007 to March 2016, inclusive of the last statistic, they've averaged 875. The average for this period from here to here, from the beginning of the statistic till the end of 1999, is 1.509. So it's right about here, actually. So this deficit is the deficit that I was speaking about earlier. Okay? So let me just put this one back. Okay, here we go. Everyone should see that chart. Okay. So as with the labor force participation rate, which is telling you something which is not explained by the aging of the US population. This chart also, directly from the housing statistics, is telling you that something else is at work here. That when economists and others tell you that the US economy has recovered, and they cite housing statistics, housing sales statistics, it's not an accurate depiction of the market. That deficit is telling you that the demand is not there. Because what would happen if the demand were there? Then all the housing companies that want to make money would go out and build houses. The statistic's existence and its level tell you, let's take another look at this, that that's not the case. Okay, here comes another chart. Okay, that was housing starts. This is new home sales. A good proxy, because I couldn't find the other statistic for the overall US housing market. And again, we can see that except for the housing bubble, new home sales is not related to the increase in population, but to the delta. Now, there's a difference here. The interesting thing here is that the housing start statistic had a peak actually back in the 70s, 72. Here, on new home sales, we have a peak here. Now, part of the reason for that is the huge amount of, well, we don't know how much actually, retract huge. The amount of multiple ownership and flipping of houses during the housing bubble. Okay, and those are largely, not completely, but largely new home sales. So the prior peak was 880 back in 86. Once we broke through that, you could do another definition, if you will, an 01 of the increase in the housing. Okay, and again here, this is the 10-year average right here. Until the housing bubble, it's somewhere around 600. Okay, I'm a little bit more, sorry. It's somewhere around about maybe 650, okay? So 650 is the average, just say, prior to 1999 or 600, either way. You can see that where we are now, again, in new home sales is not indicative of an economy at health. So for these statistics, and all of them portray the same thing, the recovery, let's see if I can find another good one here for you. Housing starts, existing home sales. Oh, this one, let me use this one. This one I wasn't quite sure what to make, but I'll just show you briefly. It didn't exactly show what I wanted to. Okay, this is existing home sales. This is median home price. I couldn't find existing, as I said, existing home sales. This is median home price. Going back to 1970, okay? And Fed funds. Again, a good proxy for mortgage rates. You will also hear home prices have returned to their prior levels, and this is a good thing. This is nonsense. Nonsense. If the old price was a bubble, then how is the new price anything but a bubble? If the economy is roaring, as we know it's not, and that is indicated by rising home prices, then what are we doing down at that miserable Fed funds rate? So again, the statistic is being used and has been quoted as an indicator that the housing market not only is fine, which to my mind is nonsense, but that it depicts an economy that is stronger than statistics. Those statistics would be, of course, 1.4% of GDP in the fourth quarter and approximately somewhere between 0.3 and 0.6 in various estimates right now. No. What the housing price is telling you is that homes are receiving an inflated value because of the permanent low interest rates. I cannot depict or portray these 2 points, this one here and this one here, as an indicator of health in the economy. When you get a change in slope, remember the population line, very stable in slope. And if you depict the housing price here, relatively stable in slope till just about here. Depiction of a relatively, certainly from this period on, stable inflation rate. This nonsense is a product of largely monetary policy and a declining growth rate. Okay, so let us just, guys, it's about the end here, so I just want to go back to where, to summarize what we're talking about here. We'll just put this other chart up so that we have a better picture. Come back. Okay. Remember what I'm trying to do here, and what I've tried to show here, that the U.S. housing statistics depicting a vibrant U.S. economy, I do not take to be true. The inability of the housing, and the unwillingness of the housing sector, because remember, the housing sector is composed of what? People buying houses and people building homes. That's what it is. The home construction industry is indicative of the health of the economy. And it absolutely is not portraying an economy ready to break out, an economy moving along, an economy that is improving. So looking at these second level statistics, which is something I think we have to do. You know, whenever I listen to people talk about the economy, especially around non-farm payrolls, and I hear this statistic again, the greatest run of economy, and job creation in 15 years, and okay, great. One, job statistics are very highly seasonally adjusted, shall we say. If all of those people were getting jobs, they are getting jobs, I don't discount that, jobs that would permit them to improve their lives, to do with the things that they want to do. Again, we assume that the cultural bias towards home ownership has not changed in percentage, although that could of course be possible. Then the non-farm payrolls are not giving a good indication, a good depiction of the health of the U.S. economy. And if they're not, and try and remember that when non-farm payrolls rolls around, and for the 3 weeks after that, you hear people saying that the economy is doing well, look at the jobs numbers. Well, the jobs numbers are not sufficient. And if we need any further indication on this, we can look at the Fed fund policy itself. The Fed has been unable to raise rates, even though it says that it will. Okay, folks, I'm going to take this theme to some other statistics in the future. I'm not exactly sure what I'm going to do. Next week, we are dealing with sterling and its crosses. I did not mean that to be some sort of reference to the British vote on remaining in the EU. However, it does work. I'm going to take a look at those. So I thank you all for coming this week. I hope it was useful. Everyone have a great day. Let me type in, well, if I can figure out how to do it. Last week I couldn't. Figure out how to, Adinda, if I can't get this, my email address in there, would you type it in? You had to do that last week. For some reason, I don't seem to be able to type it in here. Anyone who has any questions or comments, please send me an email and I'll be glad to address the issue. Again, thank you all very much for attending. Everyone have a good day, and I suppose I should say happy trading. Take care.